I meet with business owners who are making financial planning mistakes that cost them tens of thousands of dollars per year with their RRSP without even realizing it. And I guarantee you, you are making them too. By the end, you'll understand how to use your RRSP and save potentially hundreds of thousands of dollars in unnecessary taxes over your lifetime as a business owner. I'm your host, Guillaume, wealth advisor and financial planner, and I want to welcome you to the Personal CFO podcast. If you're listening to this episode, it tells me something about you. It tells me that you're not just focused on making money, you care about growing your money tax efficiently. And you understand that once finances gets complex, mistakes get expensive. And you're looking for clarity, structure, and decisions that will hold up over time. You're not looking for hypes or shortcuts. And that's the right mindset to have. And that mindset is actually what builds long-lasting wealth. The name of the game is to get money out of your corporation as tax efficiently as possible. And that's exactly what a tool like the RRSP can help you achieve. There are many tools that can help you achieve that, and I'm going to cover all of them through the Personal CFO podcast. So make sure you're tuning in. If you're incorporated and you start accumulating surplus cash, also known as retained earnings, in your corporation, you need to make two decisions. Sorry, I had to let my cat out the room. You need to make two decisions. First is where to invest your money. Do you leave it in your corporation? Do you take it out? Do you put in RSP, a TFSA, a non-reg account? That's the first decision, which is the topic of today. The second decision is how do you invest it? This is a topic that I'm going to cover in a later episode. So make sure that you're subscribed wherever you're getting this content, because more of this content is coming your way. And with each decision, there'll be trade-off. If you keep the money in your business and you reinvest it in your business by hiring more people, upgrading your equipment, you want to acquire competitors, maybe you're building new infrastructures and processes. Those are all great initiatives that potentially will massively increase the value of your business and potentially really help you with the exit value that you will get if you are able to sell your business one day. But you can also start investing in other asset classes that are unrelated to your primary source of income from your business. You can keep the money in your business and invest in public equities, private equities, fixed income, commodities, private and public real estate, hedge funds, you name it. You can also put money into a permanent insurance policy. I will cover permanent life insurance in a subsequent video, and I will evaluate all the intricacies of it, how it's constructed, how it's invested, and how it stacks again the other investment options that you have as a business owner. So I'm going to park this now, but make sure you follow along because this will be covered on this podcast and YouTube channel. But all these options are leaving you with the same problem. The money is trapped in your corporation. Now, why is this bad? Well, in your corporation, when you're investing, you're paying taxes. When you're taking money out of your corporation, whether it's a salary or dividend, if it's a taxable dividend, you're paying taxes again. And if you only paid yourself dividend and you don't have anywhere to shelter your investment growth personally, like you don't have RSP room, you're paying taxes again, unless it's in your TFSA. But TFSA is only $7,000 a year. You're paying taxes everywhere. And now you're facing 3 layers of taxes. So there are only 2 ways to get money out of the corporation. You can pay yourself a salary or you can pay yourself a taxable dividend. Now, there is a tax-free dividend. It's called a capital dividend account. So check out my last video, episode number 33. I covered the CDA in great detail. And this is one way that you can pay yourself a tax-free dividend out of your corporation. But that's why the RRSP is not just a retirement account. It's a strategic tax planning tool. And that's the topic of today. And I'm going to explain you why. The RSP is going to help you reduce your lifetime taxes. It's going to help you create personal wealth outside your corporation. One of the decisions you need to make is where you invest your money. And the RSP is a tool that will help you diversify your savings and your surplus cash away from your corporation, and that will allow you to do it personally. It's also a tax efficient way to make sure that your investments are sheltered from taxes while it's growing. And Tony Robbins talked about the concept of always building 2 businesses as early as possible. And I thought that's a great approach. You do have your primary business that is your main wealth engine, but as soon as you can, you should consider building a second business that we call your portfolio, your investments, that will also act as your second business. These 2 businesses will be growing together, and they'll also be 2 different sources of income either early in retirement or even throughout your retirement, especially if you end up selling that business. Now you'll be able to just amalgamate all your investments together and then live off that. But if you can build two businesses, I think there's a great advantage to do that as far as reducing your risk and being reliant and having all your wealth in one business. Now, a lot of people will contradict this mindset because depending on your wealth aspirations in life, if you look at all the billionaires and multimillionaires, they went all in into one or two businesses and they've tried to squeeze everything out of it. They've reinvested all their money into it and they try to maximize the exit value. So if that's the route you want to take in life, I think it might be suited for some people. But for the vast majority of people, thinking of diversifying can be a really great mindset to have to reduce your stress level and help you achieve your goals and have way more than enough around money. So it just depends on what's your outlook on life and how you want to go about building your wealth throughout your life. Lately, I've been listening to this podcast called the Founders Podcast, and it's been absolutely amazing. If you're building a business or you're interested in learning from all the business moguls around the world, I would highly encourage you to tune into the Founders Podcast. But so coming back to the conversation of today around the RRSP, it will also help you protect against potential corporate tax changes because as we've seen, we came close to having a change in the capital inclusion rate, where it almost went from 50% to 66%, which means that if you had left all your money inside your corporation, you would have been worse off than if you had used other tools because taking money out would have been a better play. Now, thankfully, this didn't go through, but it just showed us that we are exposed to tax changes going forward, and we don't know what kind of tax changes will be implemented in the future. So it's important to not try to predict tax changes, but make sure you're well positioned that if some happen, you're still not worse off because you went all in into one strategy and then suddenly that strategy backfired because of a certain tax change, right? And the RSP is going to help you smooth your income across decades. So I'm going to break down the RSP strategy for business owners in a way that actually makes sense. I'm going to walk you through the salary versus dividend trade-off, why the RSP is more of a strategic tool than most business owners think, how it can protect you and your small business tax rate, how it ties into selling your company one day, and how to think about withdrawals in retirement so you don't create a tax mess later. There's about 8 mistakes that business owners make, and I'm going to walk you through all of them today. So let's start with mistake number 1. It's around your compensation structure. First thing you need to understand is that RSP room is not automatically for business owners. To create RSP contribution room, you need what the CRA called earned income. And for most incorporated business owner, earned income means salary. Dividends don't count as earned income. They don't generate RSP room. So if you pay yourself $100,000 in dividend, your new RSP room is essentially zero. If you pay yourself $100,000 in salary, you create about 18% of that of your salary in RSP rooms. That would be $18,000 to a maximum annual amount of $33,810 in 2026. So that means in 2025, you needed to pay yourself a salary of $187,000 and change to maximize your RSP contribution limit in 2026. So in 2027, the limit is $35,000, $390, which means you need to pay yourself $196,000 and change in 2026 to maximize that amount next year. So that's the first fork in the road. Salary creates RSP room, dividends do not. So now our common objection is, okay, Guillaume, but salary comes with friction. It means I need to pay into CPP, payroll admin, and remit taxes up front. Dividends seems a lot simpler. Why would I choose a salary just to get RSP room? That's a fair question. Salary does come with friction. And as a business owner, you pay CPP. You pay both the employee and the employer's portion, which is 5.95% up to $74,000 of pensionable earnings. And now we have an enhanced CPP, which is 4% up to $85,000 in salary. So the maximum combined premium in 2026 for CPP is $9,293 in Canada and $9,791 in Quebec. That means it's just shy of $10,000 that you are not getting. You're all putting into a tool like CPP, which you're not investing personally or you're not using personally yet. But wait a minute, like CPP is not a tax. It's a guaranteed retirement income that will be adjusted for inflation, which is a really important benefit once you are in retirement, because as a business owner, you almost have nothing that is adjusted for inflation. And doing that personally is a lot harder than we think. So that's going to be for another episode, the benefits, advantage, disadvantage of CPP, who should or shouldn't even consider it. It also comes down to your level of wealth, of course, and other factors, which I'll cover in a separate episode. So make sure you tune in and you follow along if you care about growing your wealth and leveraging all the tools, of course. So salary is a tax deductible expense to the corporation. So you'll pay less tax corporately, but you'll pay more tax personally. And the dividends is the opposite. Dividends don't reduce your corporate taxable income because it's not a tax deductible expense, but you'll pay less tax personally because dividends are usually taxed more favorably. So all in all, you're now looking at this concept called integration, because in an ideal world, corporate and personal tax rates would be perfectly integrated. Whether you're earning $1 in your corporation and paid it out to shareholders should be equal to the same dollar that an individual is earning. But in reality, as a result of changes in tax rates over time, there's a small tax cost for business owners or business income in the majority of the provinces. So the tax savings or the tax cost actually refers to the tax decrease or increase in tax payable if the company pays a dividend rather than paying a salary. And this means that the combined tax paid by the corporation and the shareholder will actually be marginally higher in most provinces if the business income is distributed as dividends rather than salary. Which is, to recap, when you pay yourself a salary, it reduces your corporate taxable income. It creates RSP room personally, which allows you to defer taxes to the future. It builds CPP benefits, which may or may not matter to you, but it's still part of the equation. So the decision isn't simply salary versus dividend. The decision is, do I want simplicity today, or do I want more strategic retirement structure for the long term? And now let's talk about why the RRSP can be a strategic tool even when the corporation or investing within the corporation looks like a better deal. Because this is now mistake number 2. A lot of people are completely ignoring their RRSP and they're solely investing within the corporation. And that can be a big mistake. But I understand why people are looking at doing this, because let's play the devil's advocate for a second. You might be thinking, my corporation has a low tax rate on active business income. My personal tax rate is really high. If I move money out personally and I'm paying more tax, why would money in the company and invest within the corporation? Because on paper, leaving money in the corporation looks like an obvious win. The corporate tax rate on active business income can be as low as 9 to 12% and change. So you keep more money invested up front. You avoid paying 53% in marginal tax rates if you're in the highest marginal tax rates personally. You avoid CPP and payroll administration, which I just covered. CPP itself can be potentially an extra close to $10,000 in your pocket or for you to invest instead of having it contributed to CPP. So it's tempting to think, why would I ever move money out? And yes, leaving money inside a corporation, you avoid immediate personal tax, which means you have more starting capital to invest, and compounding a bigger base is powerful. So let's look at how powerful it is to compound a bigger base. But when you invest in a corporation, you're still exposed to taxes and you're exposed to the distributions that you're getting. So interest income, dividends, and capital gains. So I'm looking at a research here by Jamie Golenbeck at CIBC, which is a leading tax expert in Canada. And he's looking at investing within a corporation by deferring all the capital gains to the future. Then investing within a corporation by realizing the capital gains every year. Then looking at investing in a corporation by only receiving eligible dividends. And finally, investing in a corporation by only receiving interest. So you'd be in 100% fixed income or GIC. And then we compare all these scenarios to investing in an RRSP or TFSA, which is holding all types of incomes, because that's one of the big drawbacks, so to speak, of an RRSP or TFSA is that you're losing the origin of the income of the distribution that you got. In a corporation, you're keeping that origin, whether you're receiving a dividend or a coupon from your fixed income investments, you're keeping that origin. But when it gets to an RSP, when you take the money out, it gets added to your taxable income for that year, and you're losing that source of that distribution, which may or may not be an advantage depending on the scenario. So now if you look at that compounding effect over that time period, over a 30-year period, the number one would be if you were able to invest in a corporation and you deferred all the capital gains to the future. Now, how realistic is that? Not very likely, because most likely you will have investments that will generate dividends. And depending on your risk profile, if you do have any allocation to fixed income, that will automatically put you worse off than if you invested in RSP or TFSA. So the only way you would be better off with investing in the corporation is if you can invest in 100% equities with zero distributions, essentially. And you're either deferring all your capital gains to the future, or even if you're realizing your capital gains annually, you will still be slightly better off than if you invested in an RSP. Now, that's someone who is able to take, I would say, have a high risk tolerance to risk to be in that kind of portfolio. So as a rule of thumb, when the personal tax remain constant over time and you're investing over long periods of time, the RSP and the TFSA will beat leaving funds in the corporation unless the corporation earns nearly exclusively capital gains, which are only 50% taxable. And that's why this is so advantageous, because the other 50% that is not taxable, you can take it out through the CDA, which I covered in my previous episode number 33. So as another rule of thumb, it generally would not make sense to receive a salary or a bonus for the sole reason of making a maximum contribution to an RSP if the remaining after-tax salary or bonus would simply be invested in a non-registered investment that produce a taxable income. So it would not make sense to take money out personally if you would end up putting it into a non-reg account. And this is really key to understand, because of course you would be better off to leave it in your corporation or move into a holding company and invest it there than take it personally and just leave it in a non-reg. So it would be preferable to leave after-tax business income in your corporation to take advantage of the significant tax deferral that provides additional corporate funds for investments. But there's a catch that has got much sharper in recent years, and it's the corporate passive investment tax rules. If your corporation earns passive investment income, like interest, dividend, or capital gains in your portfolio, which even if you think that you can earn only capital gains in your corporate investments, at some point, you will have to lower your risk. You're not going to carry 100% equity, 100% deferred capital gains. At some point, you'll need to realize capital gains, and you actually have to de-risk your portfolio because you will start needing income in retirement, or dividends or interest income, and that right away will put you worse off than if you had used an RSP or a TFSA. But on more so than that, once you leave all your money in your corporation, at some point, you will see your small business deduction being grinded down. So in practical terms, it means that if you accumulate too much wealth inside the corporation and the corporate investment account starts to generate meaningful passive income, the government will claw back your small business deduction. And that can push your active business income into a higher corporate tax rate. Let me explain that to you. Once your corporation is earning over $50,000 in passive income, you will see your small business deduction tax rate being grinded down. So if for every $1 of passive income above $50,000, you will see your small business deduction being reduced by $5,000. Here's how it works in plain language. The federal small business limit is $500,000. Once your passive income exceeds $50,000, the grind begins. So for every $1 over 50, you lose $5 in small business limit. So once you've passed $150,000, the entire $500,000 small business limit is now being eliminated. And now you're being taxed at the general rate. Now to get to $50,000, think about it this way. If you have an investment portfolios that generate 2% in dividend yield, well, you'll need a $2.5 million portfolio, which is pretty significant. But if you have a portfolio that generates 5% dividend yield, you only need 1 million. And a lot of people are saving that we work with are saving hundreds of thousands of dollars per year. And depending on how they're invested, especially as you near retirement, you can, and you're still working, maybe you phase your retirement, you can get there pretty easily, especially if you tilt your portfolio being with stocks that are heavily tilted towards like high dividend paying stocks. The point is, it's not as big of a threshold as you think it is, depending on how your portfolio is structured. So this is one of the biggest reasons why RSP remain a valuable tool for business owners, because it helps you move money growth on your investments out of your corporation and into your personal name within the RSP. And the investment growth inside your RSP does not count as corporate passive income, of course. So using your RSP can help you reduce your corporate passive income pressure, because it's helping you diversify your wealth as early as possible so that you can push that limit down the road. So in other words, the RSP can be a release valve. It can help keep your corporation leaner and cleaner while still allowing you to build long-term wealth for retirement. Now, the next questions become, how do I actually move money from my corporation into an RSP in a tax-efficient way? So how do you fund your RSP from your corporation? Your corporation cannot contribute directly to your RSP, at least the way we're set up with our investment dealer. I cannot put money directly from your corporation to your personal RSP account. It has to go through your personal checking account first and then move to your RSP. So this is really important. And the takeaway from this part is that it's a tax neutral event. When you pay yourself a salary from your corporation, if you want to pay less taxes upfront, you can file a form T1213 that will reduce the amount of taxes you need to remit upfront. So you can pay yourself from your corporation to you personally a salary or a bonus, and then take that bonus and put it into your RSP. And depending on whether you've paid taxes up front or not, you may or may not get a tax refund. But the point is that it's a tax neutral event. You're literally just moving money from the corp to your RRSP. And if you didn't pay taxes when you move money from the corp originally, you're not going to get a tax refund once you've made once you've made your deposit. So again, it's just a tax neutral event. It's a way to take money out of your corp, put it into your RSP, invest it in a tax deferred basis for the future. The key point is that the RSP, your investment growth, is tax deferred versus that if you left it in the corporation, you would have been subject to annual taxes on interest, dividends, and any capital gains that you realizes. Another thing to mention too is within your RSP, if you need money, depending on your circumstances, or you can take it anytime. You're not locked in. Yeah, you'll have withholding taxes up front depending on how much you're taking on, but you can take money out of your RSP at any point in time. It's not the end of the world. And you can also structure it in a way that you can have the minimum withholding tax up front so that you're under the $5,000 threshold, for example. So don't think that your money is just locked there and it's the end of the world if you have to take it out. That's another thing that you might want to keep in mind if you're ever in a unfortunate position where you actually need to tap into your RSP for various reasons. But when you eventually withdraw your money from your RSP in retirement, you're going to pay whatever personal tax rate at that point in time, because with your RSP, you lose the origin of the distributions, like I mentioned earlier. Everything gets taxed as income for that year. So the RSP is essentially a tax timing tool. You're using high income years to create deductions and your different taxation to lower income years. But I'm going to cover in another video the RSP versus TFSA versus non-reg. Even if you're contributing in a tax bracket and you're withdrawing in a higher tax bracket in retirement, which that's why a lot of people think that RSP is complete trash, because they think, well, my wealth's just going to continue to grow significantly. But even if that's the case, the RSP is still advantageous. And I'm going to cover that in a completely separate video. But now to be clear, the whole point is that this needs to be properly coordinated. Your compensation strategy, your salary, your dividend, how much you're paying yourself, it's not something that you decide in isolation. It affects your CPP, your corporate tax, your personal tax, your RSP room, and your long-term retirement modeling options. So this brings us to another strategic angle that business owners often miss: keeping the corporation clean for a future sell. And that is mistake number 4. If you think you're going to be selling your company, you want to think about purifying your corporation, especially if you want to use the lifetime capital gains exemption. So if you plan to sell your business one day, there's a massive tax opportunity in Canada called the lifetime capital gains exemption. It allows you to essentially claim $1.25 million in capital gains per shareholder to be tax-free when you sell qualifying shares of your business. But to qualify, your corporation needs to meet certain tests. And one of the risks business owners run into is letting the corporation become stuffed with passive investments or excess cash over time. And that makes the qualification harder if you don't plan ahead. Now, there are a number of planning tools that tax lawyers, accountants can use, and financial planners can help you anticipate and implement early so that you do end up qualifying and you're well positioned to qualify, which I'm going to cover in a subsequent video. But so over the years, one of the strategy is actually to gradually move your surplus corporate wealth into personal registered accounts. And that's why the RSP can be an efficient tool to allow you to do that throughout your career in order to allow your corporations to stay cleaner and more focused on your active business assets instead of being mixed with all sorts of investments commingle with your primary or your active business income. And this is part of what we call the purification planning. So even if you're not selling tomorrow, the business owners who get the best outcome are usually the ones who prepare years in advance, especially if you intend to claim the lifetime capital gains exemption. A lot of the rules and the tests require at least 2 years to meet certain criteria. So you need to think years ahead. And the RSP can play in supporting you in achieving these goals and meeting these tests. Now, I want to mention that one more tool that comes up in our conversation is actually the IPP. So I'm not going to go too deep in today, but I want to touch on the IPP and I want to explain at a high level why it's important and why some business owners might be a really good fit for this tool. And this is mistake number 5, completely ignoring the IPP or not knowing about it. Now, if you're incorporated and if you're over 40 years old and you're earning strong income consistently, you may have heard about having your own individual pension plan. An IPP, it's just a super RRSP. Now, there are some intricacies as far as like it's a defined benefit pension plan and it's designed for business owners and to help them contribute more than they would in an RRSP. Now, there's a few differences compared to the RRSP, but the concept is the same. If you've maxed out your RRSP, you can use an IPP to move your room even higher. But the concept is the same. You're moving money out of your corporation into another account, which is going to be an IPP, and you're going to be able to move more into an IPP than you would have moved into an RRSP. It depends on your situation, of course. It's very case by case. But the corporation contributes, so the contributions to the IPP are tax deductible to the business. It's a deductible expense, similar to an RRSP. And then it can also provide strong creditor protection, similar to the RRSP. But the trade-off is that there's a bit more complexity and cost with the IPP. It requires you set up fees, actual reports, and ongoing compliance. If you want to learn more about IPPs, you can go back to episode 17. I had a conversation with Tatenda Mayoho from GBL, which is a leading expert on individual pension plan in Canada. So check that out, episode 17. But yeah, so for the right person, the IPP is a powerful tool. It's not automatically better though. The RSP remains the flexible foundation for most business owners, and then the IPP becomes the upgrade for certain situations. So now let's talk about the risk management briefly, because as a business owner, liability matters. And in terms of mistake number 6 is if you're not careful in terms of where you're holding your assets, maybe you're overexposing yourself to lawsuits, creditor issues, business risks by leaving assets inside your operating company. So you might want to think, okay, what are my tools and what are my options to reduce my risk exposure there with the surplus cash that you're accumulating within your company? And your RSPs can generally be a great protection there in terms of creditor protections under federal insolvency rules, but there's some limitations. The point isn't that the RSP is like a bulletproof, but the point is that moving retirement assets outside the operating company can improve your risk profile. Now, you might want to think of using a holding company for layer of protection as well. So there are other tools to help you achieve that. The RSP is just one of them, but it is a clean personal structure that help you add this layer of security and separation. So now let's go to the part that most people ignore until it's too late, which brings us to mistake number 7. In retirement, how do you get money out of your RSP? Because it's not just about the contributions, it's also about how you're going to withdraw this amount. And one of the benefits of contributing to an RSP is the ability to, in the withdrawal phase, to split income with a spouse or a partner, either with your spousal or your partner RSP, and by splitting pension income on your tax return. Now, I didn't cover it in this episode, but in your accumulation phase, you would have not just contributing to your RSP. If you're in a situation where there's a big gap in income between one spouse and the other, you would have most likely leveraged a spousal RSP to help you reduce your future taxable income as a household, especially if you want to retire early. Because pension income doesn't include RSP withdrawal, but it does include RIF withdrawal once you've moved your RSP funds to a RIF and you are 65 years old or older. So the spousal RSP really comes handy if you want to retire early. And again, if you do have a big gap between the two spouses, then that's going to really become handy. But then as you cross the age of 65, when you convert your RSP to a RIF, then you can start splitting income anyway, which makes the spousal RSP kind of irrelevant at that point in time. So by the age 71, your RSP must be converted to a RIF. And once it becomes a RIF, your minimum withdrawals are mandatory. You don't dictate how much you're taking out of the RSP. And that means that you lose some of the flexibility over your taxable income later in life. But the corporation is the opposite. Your corporate assets can be extremely flexible. You decide when to pay, how much to pay yourself in dividend and when you pay yourself dividends, that's why the corporate tax deferral can be advantageous, because you have full control throughout your entire life about how much money you're actually taking out of your corp. You can leave money in your corporation, as long as you want, and potentially pass it on, which is there's that whole opened the discussion for a whole suite of strategies as far as how do you pass on your wealth to the next generation. That was also a comment around the IPP, which can be pretty handy as well if you wanted to use that as an intergenerational wealth transfer tool. But in retirement, the best outcome usually comes from coordinating multiple sources of income, right? You're going to have your RSPs or your withdrawals. You're going to have your corporate dividends. You're going to have your CPP, your OAS, and sometimes even capital gains on your non-registered assets. So the goal is to keep your taxable income in the right range, high enough to live well, support your lifestyle, meet all your goals based on your values and what's important for you in life. But you don't want your taxable to be too high or unnecessary, and then have unnecessary clawbacks as well. So you want to be in that sweet spot. And this is where the planning becomes incredibly personal. There's no one size fits all. And it's exactly why business owners benefit from having someone who can quarterback the strategy over time. So before I wrap up, I want to make this practical. So when does an RSP strategy actually make sense for business owners? And this is usually mistake number 8. When does it make sense? And by what age and income? So if you're in your 30s, and I'm assuming you're in all of these scenarios, I'm assuming you're a high income earner here, meaning because the higher your tax bracket, the more beneficial each RSP contributions are. So if you're in your 30s and you're a high income earner, your RSP strategy can be a powerful tool to shelter investment growth and shelter your investments from taxes. Now, if you're in your your RSP contributions are often one of your most valuable tool as well, because now usually you tend to be in a much higher tax bracket, and so is in your 50s. It can be extremely valuable, especially if you're trying to smooth out your highest income years and build a clean withdrawal plan for later in retirement. And then even if you're approaching the eventual sale of a business, you can use any contribution room unused in your RSP to help you purify your assets from your corporation. And this is also where using an IPP can be extremely beneficial, because now you might be able to shelter a lot more than you would have in your RSP. But there's something that you need to think and keep in mind is that there are such thing as too big of an RRSP. That's why even the RRSP can be a great tool, especially in your 30s and 40s and 50s. There's a certain gap where, depending on how you invested, depending on your risk profile, depending on how much wealth you have, leaving some in your corporation, or of course having a holding company, can become extremely beneficial as well. That's why you want to manage all of these accounts. You shouldn't just go all in one or the other, because that's rarely the solution. So when you're looking at taking only dividends year after year, you might be better pausing and asking yourself if you're sacrificing long-term flexibility and tax efficiency for short-term simplicity. Because sometimes dividends are the right answer, but rarely dividends are the only long-term retirement design, which, as we covered, dividends don't build RSP room. This is why it's coming back to the first fork in the road, which this is how I started this episode. So the big takeaways: first, the RSP is not just an employee account. For business owners, it's a strategic tool to create personal tax deductions, tax-deferred growth, and retirement assets outside your corporation. Second, salary is the key. If you want RSP room, you need earned income, and dividends won't do it. Third, corporate investing is powerful, but it comes with risk, especially the passive income grind and potential pressure on the small business deduction. Your RSPs can help you reduce that risk by moving growth outside the corporation. So is the IPP. And finally, the best results come from the coordination. Salary versus dividend is not just a tax decision. It affects your CPP, your corporate tax, your personal tax, your RSP room, exit planning, and retirement withdrawal strategy. So if you're an incorporated business owner and you're not sure how to structure this properly, especially if you have retained earnings building up, you're nearing the passive income threshold, or you're thinking about retirement or a future sale, this is exactly the kind of planning that we do. Reach out and we'll build a compensation and retirement strategy based on your numbers, your timeline, and your goals. Because the goal isn't just to pay less tax this year. The goal is to design a retirement plan that works for your lifetime and minimize your taxes over your lifetime, not just in a single year. Again, thank you for listening and watching this video, and I will see you in the next episode. Have a good day.